So, have you ever needed cash in a pinch and just pulled it from your business account? It feels like the easiest thing in the world, right? But that simple transfer could actually be a ticking tax bomb. Today, we're going to defuse that bomb. We're breaking down the critical difference between a casual shareholder loan and a formal promissory note. And trust me, getting this right is one of the most important things you can do for your business.
Let's just be real for a second. Is your business kind of your personal ATM? A lot of owners do it. You inject some cash to cover payroll, you pull some out for a personal expense, but you gotta know, every single one of those informal transfers, well, it's a potential red flag for tax authorities, and they are definitely watching.
All right, so let's dig into what I'm calling the owner's ATM problem. How these little loans and repayments show up on your company's books, it's not just some boring accounting detail. It has serious legal and financial consequences that we need to unpack right now.
Okay, let's get into the nitty-gritty. When you take money out of the business for personal use, say 10 grand for a vacation, it gets recorded as due from shareholder. Now, you might think that's a bad thing, but on the company's books, it's actually an asset. Why? Because you owe the company that money. It's an IOU from you. On the flip side, when you put your own money in, it's due to shareholder. That's a liability for the company because now the business owes you. Getting this simple distinction right is the absolute first step to staying out of trouble.
Now, let's switch hats and look at this from the taxman's point of view. You know, places like the IRS or the CRA, they look at these transactions with one and really only one question in mind. Is this a real loan or is it just a sneaky way to pay yourself a dividend to dodge taxes? Their answer to that question can make or break your finances for the year. So this table right here, this is basically the auditor's checklist. This is what they use to figure out if your loan is bona fide, which is just a fancy way of saying legitimate and in good faith. They look for hard evidence. Do you have a formal written promissory note, or is it just a handshake deal? Are you charging a reasonable interest rate, something at or above what they call the applicable federal rate, or is it zero interest? And maybe most importantly, is there a fixed repayment schedule, or is it just kinda, I'll pay it back when the company's doing well? If you're answering no to these, you are practically screaming to the tax authorities that this isn't a real loan. So how do you fix this? How do you prove your loan is the real deal? The answer, my friends, is the formal promissory note. This document is the single most powerful tool you have to create what regulators call bona fide debts, and ultimately to protect your business. So what is a promissory note? It's a legally binding contract. That's it. It removes all the guesswork, all the ambiguity. It spells out exactly who's borrowing, who's lending, how much, at what interest rate, and when it's all getting paid back. It turns that casual, I'll pay you back later conversation into a rock-solid, enforceable financial agreement. And here we go. This is a perfect example of a key piece of that